What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to talk about SCHD. Now, SCHD is known to provide some of the best dividend companies that money can buy through a cheap, low expense ratio and passively managed ETF. It also provides a high yield when you compare it to other ETFs. And in addition to that, through its history, it's provided consistent dividend growth. But in this video, we're going to do a breakdown of SCHD. I'll go a bit more in depth. We're going to talk about its holdings, tax advantages, and risks associated with this investment. And then I'm going to give you my personal opinions on why SCHD is underperforming. And it's not underperforming by a little bit, it's underperforming by a lot. We're talking 5.5% year to date, over 7% in the past year, when you compare those numbers to the S&P 500 or the Nasdaq, which are both in the green for those timelines. And lastly, we'll talk about some other investments that are available that may outperform SCHD in the near future due to the current macroeconomic conditions that we face in the USA and also outside of the USA. And more than likely, they're going to continue for the near future, so upcoming years. Now, at the end of the day, you got to know that this video is just my opinion. It's not financial advice, so just keep that in mind. And with that being said, let's get right into it. What is SCHD? So SCHD is an exchange-traded fund, or ETF, that seeks to track the performance of the Dow Jones US Dividend 100 Index. This index is made up of high-quality US companies with a history of consistently paying and growing their dividends. So SCHD is passively managed, meaning that it seeks to replicate the performance of that index, not necessarily beat it. So actively managed would be a fund like ARK Invest, where it's managed by Cathie Woods and her team, where they're trying to outperform. Passively managed just means we're trying to match the performance of whatever index we're benchmarking. Now, SCHD is one of the most popular dividend investments because it provides a low-cost way to invest in high-quality dividend-paying stocks. So by focusing on companies with a history of consistent dividend growth, SCHD provides its investors with a constant stream of income that can help them overcome market volatility. So what I mean by that is, on a quarterly basis, you're going to be getting paid out your dividend even if the NAV of the fund is going up or down. So if your total nest egg is going down or up, you're still getting paid quarterly. So when I mentioned low cost, I'm talking about the expense ratio, and it's only 0.06%. This is $60 out of every $10,000 invested. This is especially important for the long-term investors because as time goes on and your portfolio grows, you're going to pay more and more money. It's the same thing as compound interest, but it's basically compound fees. So keeping that down is extremely important. It's also important because you're paying the expense ratio for the fund to do all the work for you. So this fund is going to give you exposure to high quality dividend paying stocks, but it's going to save you the time of not actually having to go out and pick them yourselves or remove them if they're underperforming. Now, when it comes to those high quality dividend stocks, it's going to be around 100, and right now it's actually at 104. So to sum it up, SCHD is considered the GOAT, or the greatest of all time, if you go in like the Reddit community when it comes to dividend paying ETFs. It's basically the full package. So now let's talk about SCHD's holdings, because SCHD does a pretty good job at balancing a good diversification across multiple sectors. You've got your consumer staples, discretionary, energy, healthcare, telecommunications, the list goes on and on. Now the top 6 holdings in SCHD are going to be Pepsi, Coca-Cola, Merck & Co., Verizon, Chevron, and Home Depot. Now while these are established companies with a long history of paying and growing their dividends, they may not be the best performers in the coming years. We don't know that yet. Now, if you were an individual investor and you were investing in these, it'd be extremely important to keep an eye on the performance of these individual holdings and then adjust your portfolio accordingly. However, luckily for SCHD investors, the ETF will remove the companies that are underperforming and it'll add new ones on an annual basis. So it does all the work for you, just like I mentioned before. So now let's talk about some risks and challenges that SCHD is going to face, or they're currently facing. I like to break them down into 3 categories. We have the interest rates, we have tax regulations, and then we just have global international companies that do business everywhere. So let's go into the first one, interest rates. Well, we're in what we call a rising interest rate environment. The Federal Reserve is doing everything they can to continue increasing interest rates, or the cost of money for people to borrow, to making money more expensive. And they're doing that because they want to slow down the economy. They don't want to put us in a recession, and they don't want to increase unemployment, but that's essentially what they're doing. Doing that is going to help them fight their number one concern, which is inflation. The only problem is with dividend-paying companies, they're going to face lower profits. If there's less demand, or they're finding it harder to invest in their company to grow it and provide more profits to its shareholders, we may see cuts in dividends. That could happen. So that is a potential issue. Another issue that kind of stems off that is when you're in an environment where rates are going to be decreasing, people like to move their money into more riskier assets. they think, oh, maybe it's time to put some of our money in small cap stocks that may grow a little bit faster. I may be able to get more profit. So there may not be as money in these high quality, large cap dividend stocks if rates start to go down. So those are two separate issues, but something that SCHD is currently facing. Right now, there's just better investment opportunities. I mean, look at the investors that are invested in Coca-Cola versus the investors this year in Nvidia. One of them has seen massive increases. Now, the second thing I mentioned is tax regulation. So with our current administration, they're doing everything they can to help the little guy. At least that's what they're saying. But with this, they want to increase taxes on corporations. And obviously, if you increase taxes on corporations, they're going to be less profitable. And once again, this is going to affect dividend-paying companies. So all the companies, not just the companies in SCHD, they're going to face the consequences if some of these things come to pass. Certain things are being prioritized by our current administration, like EVs versus fossil fuels. So, energy sector may take a hit. There's a lot of stuff that could happen. And the last thing is we got to look at things on a global perspective. A lot of these companies are massive. They're doing business with all sorts of countries. When we have trade restrictions with Russia because of the Russia-Ukraine war, or perhaps if China invades Taiwan, if we add extra sanctions or we restrict more trade, companies may see a reduction in profits. It may be harder to import products. There's all sorts of things that could happen from that. So those are the three big risks that companies within SCHD are going to face, and a lot of other companies as well. So now the last question is, what other investment options do we have? Well, I personally really do like SCHD, and I continue to buy it every time it dips. It's one of my long-term plays, and I'm going to hold it all the way into retirement. However, if we're looking extremely short-term, you can't argue the fact that at some point the FOMC is going to have to put a pause on the rate hikes, and then they're going to start reducing. It's not 100% guaranteed, but more than likely that will happen. And a lot of people are going to take their money out of safer stocks and start putting them into more risky investments because they're going to have access to more cash, and companies are going to have access to cheaper cash. So dividend companies may lose the focus for investors when investors can take their money from safety and move them into something like mega cap tech. Amazon, Microsoft, Google, Apple, Tesla, all those kinds of things. People may think that with a lower rate environment, they may get more profits out of that. So not saying that's going to happen, but that is something that could happen, and a lot of people do believe. Now, another thing is if we stay in a paused rate environment, so we get up to 5.25 or 5.5%, and then the Fed just keeps it for a year, 2 years, something along those lines. Interest rates for high yield savings accounts, CDs, even money market funds are higher than this dividend ETF pays you currently. So if you could have zero risk and keep your money in a CD, for instance, paying over 5%, why would you want a quarterly dividend when annualized to be 3.5%? You're actually losing money. Now, I know that doesn't factor in net asset value and stuff like that, because obviously you would hope that that goes up. But when you can make a lot of money from the banks and have zero risk, then people may take advantage of that. So once again, I'm just here to give you other options in terms of where to keep your money. But at the end of the day, it's up to you guys to do your own research and do what's best for you and your family. With that being said, I want to know from you guys, what do you think? Let me know in the comments down below. I do my best to answer all comments on all of my videos. And with that being said, if you haven't already, make sure you smash the like button, subscribe to the channel. We do weekly content on anything related to personal finance or fitness. I hope you guys have a great rest of your week. Take care.